This is Philip Rich, Chief Investment Officer for Seaside Bank and Trust, a division of United Community Bank. And this presentation is one in a series of updates from our Wealth Management division. For context, this economic update is being made on March 22nd, 2021. Our principal message is that the U.S. is emerging from a deep recession and a sharp recession and moving towards a sustainable recovery. Our core outlook is for continuing gradual improvement in the U.S. economy. Declining COVID infection rates and gradually increasing vaccinations support the growth theme. The U.S. is now down to 63,000 new cases daily of COVID, and that compares with 310,000 cases daily at the end of 2020. Increasing consumer spending and additional stimulus also support increased confidence in growth. Personal spending was up 2.4% in the fourth quarter of 2020, following wild gyrations in spending similar to the ups and downs that we have seen in GDP. Downside risks to this outlook include possible virus mutations, a phase out of fiscal stimulus, and any tapering of the monetary stimulus from the Federal Reserve. But upside possibilities include higher consumer spending facilitated by an unusually high savings rate. The U.S. savings rate stands at 13% versus a typical 7.5% that we've seen over the past several years, and a bounce back in the services sector brought on by pent-up demand and a relaxation of the COVID restrictions. Also, a new round of stimulus checks that are going out as we speak could also provide upside forces for the U.S. economy. Elsewhere, some recent stock market action has really been quite disconnected from fundamentals, although extremely positive for stock investors. Improving profits could provide positive support to the recent price action, but on its face, it does appear that right now the stock market is anticipating and discounting a lot of very positive future developments. GDP has returned to growth after a very sharp recession in 2020. Real GDP increased 4.1% in the fourth quarter of 2020. And more recently, we saw retail sales actually down in February month over month, although they still are up 6.3% year over year during that month. And this simply reflects the fact that this recovery will not move in a straight line, but will be characterized by some fits and starts. Restaurants were down 17% in sales in February. Autos were up 10%. Online retail is up 27%. And this follows a very strong January result for retail sales. The recovery in services is going to be key going forward. Services are 68% of the economy, and manufacturing is a much smaller percentage of total GDP. However, manufacturing recovered long before services and has been very strong throughout this recession. Right now, demand in manufacturing is growing faster than productive capacity. Manufacture is currently being constrained by supply problems, most notably with chips, computer chips. The current growth follows a very dramatic dip and subsequent bounce caused by COVID in 2020 and the subsequent COVID lockdowns. A growth rate above 5% is really achievable for 2021, given the fact that we are now embarked on a recovery And we've seen several estimates as high as 6.5% real GDP growth for 2021, which really would be extraordinary when compared to other growth rates for the United States in this century. There are still some notable downside risks, but that is the core forecast for 2021. Turning now to employment, unemployment has quickly returned to 6.2% in February after spiking as high as 14.7% last April. There are an estimated 10 million people who remain unemployed from the impact of COVID on the economy. The headline unemployment number may also be masking some persistent challenges in the area of employment. The labor force participation rate, for instance, is now low at 61.4%, and the participation rate is a measure of the percentage of working age population either holding jobs or actively looking for work. So the percentage of the population that is actually engaged in the productive economy is low at 61.4%. But as services come back online, hopefully this number will change and a greater number of people will come back into the economy, either finding jobs or actively looking for jobs. $22.2 million jobs were lost to COVID in 2020, and a little over half of those have been recovered. There were 379,000 jobs added in February. We will need a substantially faster pace of job growth in order to recapture all of the jobs lost. Progress on jobs may prove more difficult to sustain following the sharp initial bounce that we had in jobs. And what we are looking for really in 2021 is a gradual sustained improvement in jobs added, but it will take closer to 500,000 jobs added per month on a sustained basis to recover all the jobs lost. Inflation has risen from its post-COVID lows, but it is still well below 2%. Core inflation, which does not include food and energy costs, rose 1.3%. And the all items measure of CPI rose 1.7% in February. The primary difference between these two numbers was increased energy costs. You've probably noticed that costs have gone up at the gas pump. General inflation is not a great concern for 2021. However, investors and decision makers should remain vigilant in this regard. A hugely expanded money supply and ongoing monetary stimulus could engender inflation at some point in the future. Looking now to interest rates, the benchmark 10-year Treasury rate is at 1.64% at this recording, its highest level since the onset of COVID. 2020 was very strong for bond investors because when rates go down, bond values go up. 2021 has been less so as intermediate and longer rates have trended upward. Rising rates is the painful path bondholders must take to get to higher yields. However, bear in mind that the Fed could stop the rise in yields at any time with a more aggressive bond purchasing policy. The yield curve has steepened sharply so far this year. However, rates overall remain low by historical standards. The stock market has fully recovered from its sharp sell-off a year ago and has gone on to reach significant new highs. Large amounts of new money created by monetary stimulus has supported the upward movement of broad stock indexes. Valuations remain very high for both stocks and bonds, and these very high valuations could set the stage for some kind of a correction at some time in the future. However, the timing of such things is virtually impossible to predict. This concludes our presentation for March 2021. Thank you for joining us. If you have any additional questions, please contact us at Wealth Management, Seaside Bank and Trust.